Welcome to Mark's Trading. Today we are going to talk about day trading and high frequency quants and how they come together and why it's so extremely difficult to consecutively make money trading intraday. Now, there are circumstances that will present from time to time that we'll discuss where day trading does make sense. However, it is not possible for the large majority of those traders out there. I don't care if you're a professional or if you think you have some type of secret signal to produce high conviction intraday trades over and over every single day, year in and year out. It doesn't exist unless you're a high frequency systems trader. So here are the 4 issues with intraday trading. Number 1, short-term technicals lack predictability. We're going to discuss that on the next slide. Human discretionary, non-systematic, quantitative traders are too emotional. Day traders who trade specifically to make a living, that watch their P&L day in and day out, are forced to make trades. You can't be forced to make a trade every single day, or else you are going to be emotionally attached to your P&L. Number 3, not enough high conviction catalysts 5 days a week every single day of the year. They don't exist. Then lastly, number 4, which we will talk about in more detail, high frequency trades. These traders implement too many different strategies that will just chop you up. 2 of the most commonly well-known strategies that these high frequency traders, and they're trading in milliseconds, like vol stop hunting and momentum ignition. All right, so why is there a low probability in terms of a technicals predictability on a very short-term basis? Well, there's not enough data. That's it. The more data you have, the more reliable the signal will be. Now, we have talked about in past videos where you have so much data it will lag and it's already made a significant move. But at the end of the day, if you're looking at a 12-month look-back period, that amount of data is going to tell you a lot about what is happening with that stock. That is going to give you the confirmation you need and the momentum to understand how strong and robust that signal is. Same thing with a 12-month. Now, 6 months. 6 months might not be as strong, so maybe you'll blend the two together. But in terms of looking at a 5-minute chart, that is not powerful enough. It's at 1 hour is certainly going to be stronger than a 5-minute, and a 30-minute is going to be stronger than a 15-minute, and a 1-day signal is going to be much stronger than a 14-day, and so on in terms of that look-back period. But the less data or the less price series information, because we're talking about price series here, we're not talking about fundamental data. Price series in, I would say, our world, what we look at in terms of trend followers, will be open, high, low, close price series information. But if you don't have a lot of data, the relevance statistically is not as strong. So trading off of a 2-minute, a 5-minute, or maybe even a 15 and a 30-minute chart intraday, the signals are going to be a lot less weak. You're not going to have these incredible setups every single day. All right, let's take a look at number 2. There's not enough high conviction catalysts 5 days a week. There's just not. Trading for 25 years, there's some days where I just sit on my hands and do nothing because there's not a high conviction level. And while that does hurt because I have to pay the bills because that's the only way I get paid, I don't want to lose money. So the first rule is if there's not a high conviction idea, and what you should be doing is grading each of your own ideas from an A to a D or an A to an E, whatever it might be. An A catalyst is a high conviction, B is not as high, C is really just kind of middle of the road, and so on. But this will help you in terms of how you want to risk your capital. And in terms of other catalysts besides price series, what is moving in terms of a catalyst? Is there a specific economic data point that has come out that the market was not expecting? Is that going to move the market? Is that the catalyst for the day? Well, you're not going to get one of those every day. Is there a geopolitical risk that was taken off the table or put back on the table that is going to move the markets that day? Or is there an asymmetric risk that a company has just presented some type of fraud from the C-suite? That's not going to happen every day. Now, there's upgrades and downgrades every day, but the more I see upgrades and downgrades from the sell-side analysts, it's moving stocks less and less. I have found that the buy side, which are hedge funds, institutional traders, they are using less and less of sell-side research, and hence stocks are not moving as largely as they used to do in the past. All right. Now, there are certainly periods where we can make money day trading, and where I have been the most successful in terms of day trading, and quite frankly, it has nothing to do with signals. It has to do with periods of extreme stress in the market and volatility. As we know, one of the most popular strategies is just really selling volatility when volatility spikes, because it usually does calm down and revert. Now, I'm not saying that you should incorporate this. All I'm saying is that when volatility starts to break out in terms of looking at the VIX, maybe 30 or 40, like the credit crisis of 2018, the temper tantrum of 2011, the trade war back in 2019, 2018, and then recently COVID. These are definitely opportunities to take advantage of. You can make money, but they're far and few in between. It doesn't allow you enough opportunity over the long term. So, yes, during periods of heightened volatility, yes, you could absolutely day trade, especially more onto the long side, after we've seen the extreme levels of volatility or the VIX shoot up. All right, so in terms of the high frequency traders, when I started in this business in the late 1990s, there wasn't any high frequency traders. Today, and this was based off of JP Morgan's analysis in 2017, they said that 60 to 70% of the intraday volume is being driven by quants. Now, I'm going to have to say that a lot of that is high frequency. High frequency, they're in there in very short tick data trades, milliseconds. They're certainly not carrying overnight. They are all about taking pennies and half a pennies and getting out of the market and not taking risk. So, and I don't think by any step that they do provide any real liquidity to the marketplace. But it's definitely become harder with intraday trading and trading as a day trader now that you have so many high frequency machines intraday. And why is that? I mean, the two most simplistic signals that they are using, or strategies, the vol stop hunting or the momentum ignition, can really chop up an intraday discretionary human trader. And so just recently, and you can Google this, the white paper from Credit Suisse on momentum ignition, and they discuss it. It's defined as when a trader takes stock slowly and keeps slowly bidding up the market, and aggressively then takes out a level, or in many of the cases that I'll show you, kind of a vol stop or an ATR stop, and breaks above that point, bringing in other buyers While the other buyers are coming in, where they're taking out these vol stops or vol buys, they're selling. And then it's almost the inverse with stop hunting. They're constantly throughout the day hunting for these stops on these ATRs or volatility stops. So let's take a look what that even means visually. And I'm sure a lot of you already know what a volatility stop or an ATR stop is. So I'm just looking here on Thinkswim. And what I have here is a 2-minute chart, a 5-minute, a 30-minute, and let's say an hour. Well, all right, so what we have here is the ATR, and the ATR, if you're not familiar with, is just the average true range. Now, it's not, I'm not using the average true range oscillator, it's the average true range overlay stop onto the chart. And what we have is the open, high, low, close. It's taking the average of the open, high, low, close on a look back period. So I'm using a average true range of 20 days look back, and then a multiplier of 2.5. So it's giving me a multiplier as a cushion above or below what that average price is over the 20-day look back. Now, don't get caught up in the multiplier effect. The multiplier is really just to help you gauge how much risk you're willing to take in terms of a stop or getting into a position. It's right now we're not going to really get into the specifics of that. However, what I want to show you is what happens is, in terms of momentum ignition, once you start the machines on a shorter term basis start taking out these levels, it brings in other buyers. They know that. They will let it run and then start selling, sometimes then reverting back down to that level. Now, the stop hunting, basically, they will start taking out levels where then the shorts, so we got a 2-minute, once we break above a 2-minute, then break above a 5-minute, they know the shorts will have to start covering these stops on this upside. And then it will continually happen throughout the entire day. That's why once you start taking out levels throughout the entire day, you will see these huge moves where the market is just bid the entire day because the machines are just buying throughout the whole day looking for the next major level. So it makes it very difficult for the rational human looking at the market to really get it and understand what is happening. So that is one of the reasons also, unless you're really familiar with what is happening with how high frequency traders and their strategies, it's extremely difficult to day trade as well. It's just one more piece of the puzzle that I think makes intraday trading extremely difficult. And that's why we love trend following. Trend following, we're in the trade for 70 to 150 days. And we want trades to become very crowded and overbought so they become very parabolic and move higher. We just want to know, though, how do we be proactive to exit that position before it mean reverts, typically in a momentum crash and before that happens. So check out our other videos. We do talk about that. Have a great day.